Woo! I had to do it, guys. I had to do it. I had to go buy some more Tesla stock, and that is exactly what I did here today. I bought over $9,000 worth of Tesla stock here today. I want to show you guys how many shares I bought, the cost basis. More importantly, I want to share the 7 reasons on why I decided to go buy more Tesla shares here today, which wasn't an easy decision because whenever you buy a stock that's gone up since where you bought at, it's always a tough decision, okay? So I want to share the 7 reasons why I decided to go ahead and do that. And lastly, at the end of the video, I'm going to read you the analyst notes that are either super bearish on the stock or super bullish on the stock and what their opinion was on the earnings. I think that's always interesting to look into, as far as analysts go. The ones that are really bullish and the ones that are really bearish, what was their opinion on these particular earnings that were announced last night? So hope you guys really enjoy this. If you want to check out any premium courses, there are linked down there in the description. Also, if you want to get tickets to my conference with Grim, Stefan, and myself that's going down next month, make sure you check out that description down there, okay? So I bought some Tesla shares here, so I got 31 shares. I paid $309.37 per share. It was around a little over a $9,500 trade there, almost $9,600 in total there. By the way, it's bought in a margin account. It's not like I'm taking out margin debt to buy it. Basically, in a margin account, you can place trades without the money even clearing yet. So in 3 days, when that money clears, basically it won't be on margin anymore, all right? So this is a tough decision. This was a tough decision, and I'm going to get into my 7 reasons why I decided to go ahead and do it. But it's much easier for me psychologically to buy shares I'm down on. So let's say I buy a stock ABC at $10 and it goes down to $9. If I still love that company as much, it's very easy for me personally to go ahead and load up on more shares. Like that's just the way I do it, okay? But it's actually a much harder thing for me to get over mentally if I buy shares at $10 and then they go up and to buy more shares, okay? That's a really tough decision for me to make always. I've cost myself a lot of money over the years by not buying more shares even after they go up. Perfect example of this is Callaway. Like Callaway, I bought an initial position, I bought a little more shares, and then I should have bought way heavier into Callaway at $14, $15 when I was buying in, but it had gone up and all of a sudden it was like $15.75, then it was $16, and I was like, oh, it's gone up so much since I already bought in, I'm not gonna buy any more. That was a really, really poor decision because, Callaway's now at, I don't know, $22 or whatever. We're up 40, 50% on that position just since we bought in this year. That was a really, really poor decision. So it's always a tough thing for me psychologically to actually buy after those shares go up even more. But there are 7 concrete reasons why I went ahead and did this. Let's get into this. Alrighty, guys, now time to get into the 7 reasons why I decided to go ahead and buy more Tesla shares here today, okay? The first reason is the fact that this company is now a profitable company. Not just like, oh, they're eking out a very, very small profit. They're a massively profitable company. Like they went from taking huge losses to now taking very, very big profits. So all of a sudden this stock has gone from, oh, it was just my little spec stock out there. It was just a little speculative hold I had. It was not making any money, but it had huge potential in the future. To now all of a sudden this is a very profitable company. If you look on a GAAP basis, their profit was extremely impressive on a GAAP basis. So we're not even talking about non-GAAP where maybe they could take out this or take out that. We're talking about on generally accepted accounting principles. It was still a very, very big profit. So now all of a sudden this stock has turned in from, oh, it's a spec play to, this isn't very spec at all now. This is just a massively growing company, not just on the top line, not just on deliveries and production and all those type of things and expansion, but also on that bottom line, which has fundamentally changed the way the business is. So that's one of the reasons I went ahead and did it today. Like if Tesla was still losing money right now, or even if Tesla, let's say you had announced a quarter where they were like break even, or maybe just made a very, very slight profit, I would not have bought more Tesla shares. It was a fact that they came in with that type of profit that I said, okay, this is one of the reasons I want to go ahead and buy some more Tesla shares to, here today. So that was a very, very big reason for me personally, all right? The number 2 thing is in the conference call, I really got educated on how a lot of these things that Tesla has going on are drags on the business right now. By drags, basically what I mean is they're hurting profitability, okay? So although they announced a very impressive profit yesterday, they're not even doing remotely close to what they can be doing in the future, okay? Not just because they can expand into other markets in Europe and China and blah, 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 but mainly because there are drags in the business. For instance, service. Service is a big drag on their business right now. Why? Because there just aren't enough cars out there, just not enough Teslas out there. And the majority of Teslas that are out on their market right now are cars that are under warranty. So anytime you take your Tesla in for service right now, for most people do over the next few years, it's all stuff that's covered under warranty. However, when those warranties end, which is usually, Tesla usually has a 4-year, 50,000 mile warranty, when those warranties end and things, go wrong with cars over time, people actually have to pay out of pocket, and service revenue will go up dramatically and profits will go up dramatically, where it goes from, we have to fix everything for free because it's our warranty, to, somebody has to pay out of pocket for that, okay? That's just one example of a drag on the business right now that is hurting profitability. Like service is losing them money big time right now. But over time, as the fleet gets older and older, all of a sudden it will go from, this is a thing that's losing us money, to actually it has a potential to make them more money than anything. A lot of automakers out there make more money from service than they actually make from their normal car business or vehicle business in general. So that's something to keep in mind about profits into the future. And once again, that's just one thing that's a drag on the business that's turning into tailwind. That conference call was the best one I've heard as far as really educating me on how many things are dragging this business down and how many are going to be pushing it forward in the future. The third part is around Europe, okay? Europe, I always thought of Europe as a market that would be lesser than the United States. So I always imagine like the United States would be the biggest market for Tesla, or maybe China could be the biggest market someday. But I always imagine like Europe is going to be like a second tier to like the United States in terms of the amount of Model 3 sold there and just Teslas in general. I got educated on that conference call about the fact that there are 2-to-1 ratio of premium sedans sold in Europe versus the United States. A 2-to-1 versus there. So which means there are a lot more people in Europe who are going to be very interested in a Tesla, a premium sedan like that, versus in the United States, when a lot of us drive around in trucks or drive around in SUVs. Like myself, like my wife and I, we have one vehicle, it's an Alfa Romeo SUV, okay? My parents, they have 2 trucks and 1 SUV. Like cars are kind of like secondary almost in the United States. Like not a lot of people have cars. A lot of us have trucks, and especially out here on the West Coast, a lot of us have trucks, or a lot of us have SUVs. So the premium sedan market in Europe has a potential to actually be much, much larger than here in the United States. Also, a lot of the European countries over there, they feel very strongly about electric vehicles, and a lot of them are really pushing for electric vehicles. I've had people in my stock market membership group tell me about stories when they've gone to Europe and on vacation and whatnot, and how electric cars get better space, and they get all these privileges that ICE automakers don't get. As far as if you drive an ICE car versus an electric car, you get so many different privileges. So all of a sudden I'm starting to open up my mind, and I'm like, wait a minute, Europe might actually be a bigger market for Tesla over the next 5 years than actually United States, which in my opinion is just crazy to think about. So that is another thing that I got educated on that conference call, that I'm like, wow, there's really big potential out there, okay? The fourth part is, this is something, when I did my video about, I believe Tesla's going to go to $3,000 a share over the next, 5 or 10 years. When I did that video, I didn't even talk about this. It's something that's always been in the back of my mind, but I didn't even talk about it, but it came up on the conference call. Elon Musk talked about how in the future, they plan to have a ride-sharing / taxi network, almost like an Uber meets Airbnb. So think about Uber in the way that, Uber makes money basically by, you getting a ride on your cell phone, and, somebody pulling up to your door and you taking off, okay? As Teslas become full autonomous driving, where it doesn't even need a human in it, and that will probably take over the next 5 to 7 years, let's say. Once that becomes a reality, all of a sudden Tesla can have a fleet of Teslas out there that you can just go and Tesla will come to your house and pick you up with no driver, okay? I think that's a huge advantage for Tesla, because they're an actual auto manufacturer versus Uber and Lyft. But also, they talked about, how this could be like an Airbnb type thing, where you could actually rent out your car and make money from your car. So if your car is, fully autonomous driving, and you're not using your car, which most of the time, like our cars just sit in our garages and they do nothing, okay? Other than, if they're not, and even if you take your car to work, what's it do? It just sits in the parking lot and it does nothing for hours and hours a day. Your car is so unproductive compared to what you pay for it. In the future, you could actually rent out your Tesla to the network, and you could basically make money for your car driving people around and whatnot, which is a pretty cool thing, okay? So it would be like an Uber meets Airbnb type thing. Tesla would take their 30% or 35% commission off of each one of those rides. Imagine how big that business could be. Like, this has $100 billion plus potential in the future. It's something I have never even baked into the numbers, but it's a $100 billion plus opportunity over the next 5 to 10 years. We need full autonomous driving before this starts to take off, which is probably at the earliest 3 years, but at the latest maybe 7 years. So it's a little longer play there, but it's a huge potential, right? The fifth reason is Model Y. Once again, Elon reiterated on the conference call that Model Y should go into production in 2020. He mentioned about how basically they're done to the prototype phase now. They're into that type phase. So production for Model Y, and Model Y, I think that has just as big, if not bigger potential than actually the Model 3 does, especially if they can come in with an affordable one under $50,000. That's a price point, in my opinion, that's really big. If they can come under $50,000 for a Model Y, I think you could be looking at very strong sales. And if the upper models are somewhere around 70,000 or so, that's a big competitor for some of the higher end SUVs out there. Okay, the Model X has never been, it's never going to be a mass market type vehicle, because Model X, once you get that out the door, you're looking at $100,000 plus, okay? And if you get a souped up one, you're looking at 120, 140, 150,000. Like, unless you are willing to spend a crazy amount of money and have a crazy amount of money, like a Model X is just not realistic for you and your family. A Model Y is that opportunity. So I think that has just as big a potential, if not bigger, than Model 3 over time, okay? That's huge. And once again, reiterated 2020. Number 6 is around debt. So on the conference call, Elon mentioned that a lot of these profits, they're going to funnel those into actually paying off the debt and making that balance sheet much healthier, which is, I think, a very good thing, because you got to think where Tesla's going over time. Tesla's not just thinking about, we're competing against Ford and GM and Nissan. Those guys are almost kind of like the jokes of Tesla's competitors. Tesla's really thinking about how are we going to become a massive tech giant in the future, okay? And if you want to become a massive tech giant, you're competing against Facebook, Apple, Google, Microsoft. You're competing against those type of companies. And what you'll understand about those companies is they're all extremely profitable, and they all have great balance sheets, and they're loaded with cash, loaded with investments. There's no threat about, if their business went down, they could go bankrupt or something. If Tesla wants to compete with those guys, they got to get that type of balance sheet that has virtually no debt or very little debt and a massive amount of cash and investments, so they can go buy other companies and do things like that, make strategic acquisitions, go ahead and reinvest that into the business and do things like that. So if they can get that debt paid down and just explode the profitability, you're at a position with Tesla where they can compete much better with the big tech giants, which I think Tesla's trying to go there. That's where Tesla really wants to go. It's not like, we're just going to try to beat Ford and GM and Honda. No, they want to compete against the big dogs, okay? I think that's Elon Musk's some of his big ambitions out there, all right? And number 7 is things were just much better overall on the conference call. Like I'm very bullish on Tesla, as you know, probably one of the biggest bulls out there. But I was never expecting these type of numbers. They really blew me away. I was expecting, they could probably beat on revenue, probably a decent beat, maybe $100 million, $200 million beat on revenue. They beat by $500 million. Okay, I was expecting, maybe they'll eke out a very small profit in this quarter. They end up, coming in with hundreds of millions of dollars in profit. So those numbers just kind of blew me away. So overall, things are just much better. And these 7 reasons are why I decided to go buy some more Tesla shares today. Now I want to get into these analyst notes around what, analysts that are very bullish on the stock and bearish on the stock, what their opinion was on these earnings. Let's get into those now. Alrighty guys, now for the fun part, getting into these analyst notes that are bullish or bearish about these earnings. Let's get into this, guys. So first off here, Morgan Stanley's Adam Jonas has a buy rating on Tesla, okay? This is what he had to say. He says, Tesla, its strongest quarter in history by virtually every metric. Historically, Tesla has beat on 1 or 2 line items while missing on profit or cash flow. This quarter was different. In our opinion, one of the most important debates for Tesla is when they can become self-sufficient on free cash flow, reducing the need to tap equity markets. 4Q guidance was not that specific, but implies slightly lower gross margin and positive free cash flow, at least greater than $230 million of the convert of debt they aim to pay down. The quality of that cash flow was stronger than expected, with working capital not benefiting as much as we had anticipated, okay? Goldman Sachs' David Trambino has a sell rating on the stock. This was his opinion. Another better than expected quarter from Tesla, with automotive gross margin well above our and consensus forecasts on the back of improved manufacturing costs, reduced labor hours for the Model 3, and helped by a high variant trim mix for the product. That said, we question if this is not as good as it gets in the near-term upside surprise for shares. The company has maintained that it is designated and built the Model 3 with a target of 25% gross margin and almost achieved that this quarter, albeit a rich mix. However, with its exposure to Chinese tariffs on imported components and likely headwinds to mix as lower price point vehicles are offered, automotive gross margins likely compress sequentially in 4Q 2018 and could see further mix pressure into 2019 as the U.S. federal tax credit begins to phase out first vehicles. We raise our estimates for our 12-month price target to $225 from $200. So he's raising his price target to $225 from $200. So I guess you could say he's less bearish than he was, but still, he is pretty bearish out there, okay? Bank of America Merrill Lynch's John Murphy has a sell on the stock. He said 3Q 2018, possibly the best Tesla may see in a while. He says, many of these elements, particularly mix, are peaky in nature and they will likely fade in the future. So the burden of proof remains on Tesla to generate a core underlying earnings and cash flow absent peak factors. Following 3Q 2018, we are adjusting our forward estimates, see side table, and based on our higher estimates, updating our price target from $200 to $220. So once again, another analyst that's upping his price target out there from $200 to $220. But once again, you're going to find a lot of these sell ratings, or a lot of these people have sells. A lot of them are pointing at, the Model 3, they sold all their best, customers the Model 3 already, and now it's just going to be the $45,000 model and then the $35,000 model and whatnot down the road. When I don't think they're taking into account the fact that Tesla will continue to lower production costs on this as they get better and better, as they get more buying power out there and things like that. I think that's something they're not taking into account. Also, Europe and China are still huge markets for them that they haven't even sold Model 3 into yet, right? And there are going to be a lot of customers out in China and a lot of customers in Europe who are going to pay $50, $60, $70+ for a Model 3 who want one very bad. So if he thinks, all of Tesla's best customers, most expensive customers have been run out, no, maybe some of them in the United States have, okay? But we still got Europe, we still got China to go, we still got a lot of other parts of the world, and on top of that, you're still got a lot of people who are going to be buying, high-end Model 3s down the road, not just the $45,000 and $35,000 models down the road, okay? I don't think you just run out of demand, like BMW or Mercedes or whoever. They don't just, they just run out of demand and now no one buys a high-end car. Like, that's just not the way the world works, okay? That's never been the way the automotive industry works, and that will not be the way it works now, okay? JP Morgan's Ryan Brinkman also has a sell rating on the stock. He says, we expect a strong positive reaction to Tesla's materially better than expected 3Q results, reported Wednesday after the close, with revenue, gross margin, EPS, and most importantly, in our view, free cash flow all tracking better than was expected. Our estimates rise on the sooner than expected flipping from a loss to profit generation and from cash burn to cash flow, as we are now expect Tesla's first full year positive earnings to be in 2019 versus 2020 prior, okay? Accordingly, we are raising our December 2019 end price target to $225 from $195, which was a prior, on account of higher estimates. With that said, we remain underweight both on valuation and the concern of new stronger trajectory to earnings and cash may prove less sustainable than the market is likely to presume, including given several headwinds out there, okay? So another analyst that is bearish on the stock but is bringing up his price target to that 220, 225 level now. And this guy basically, he was expecting the company to not be, profitable on a full year basis until 2020. Now he's saying they're going to be profitable in 2019. His concerns are around valuation. We'll have to see when you have such amazing growth. Like Tesla just grew 158% revenue year over year. Okay, Tesla quarter over quarter went from taking a $700+ million loss to like a $300 million profit, like $1 billion difference there in a quarter over quarter. So the growth rates of Tesla it commands a high valuation. It should command a much higher, in my personal opinion, okay? UBS's Colin Langman also has a sell rating, okay? He says higher Model 3 pricing, 2K versus our estimate, was likely the biggest driver of the margin beat. Free cash flow of $900 million was better than our $500 million estimate due to lower CapEx, a higher than expected accrued liabilities benefit, and higher earnings. While Tesla claims it will be profitable and cash flow positive going forward, we do not see that as likely with declining prices. Tesla also claims to have no plans for a capital raise. However, our view on a Q4 or 2019 capital raise is unchanged, as Tesla will need to invest to expand Fremont reduction, build a China factory, and ramp Model Y and expand infrastructure, he is saying there, okay? Citi's Atai Michelli also has a sell rating on the stock. They say a large Q3 beat adds credibility to the Model 3 margin story, as well as Tesla's ability to financially execute on targets that were viewed as a stretch just a few months ago. We expect a positive stock reaction, as Q3 will likely bolster the bull case on Tesla's ability to profitably scale and therefore establish a greater EV lead. There's no question Q3 was impressive nearly all around, but what the quarter likely won't settle is a prevailing debate around Model 3 volume versus ASP versus sustainability into next year, tax credits, trim mix, post-launch, on lingering legal regulatory risks that hover over a stretched balance sheet in our view, okay? Now, Baird's Ben Kallo has a buy rating on the stock. This is what he said, okay? Reiterated outperform rating, Q3 results beat our and consensus estimates across the board, highlighted by a strong free cash flow of $881 million, which should help bolster the balance sheet and mitigate concerns over cash burn. Importantly, Tesla reported a Model 3 gross margin of 20%, which significantly exceeded our expectations. Management indicated it believes Tesla can be sustainably profitable and cash flow positive moving forward, which we think could help flip the narrative. We expect shares to trade higher following the blowout quarter, and we remain buyers, okay? Barclays' Brian Johnson has a sell rating on the stock. This is what he had to say. He said, Tesla noted it continues to move ahead in China, a key point bulls were looking for, and will produce some components there in 2019. With stronger than expected cash and operating results, liquidity concerns off the table, we would expect the short covering momentum in the stock to continue, and at some point we would expect to return to the question of longer term valuation. We remain underweight with a $210 price target there, okay? Now for a couple bulls out there, all right? Oppenheimer's Colin Roush has a buy rating. He says all eyes now turn to the 2019 debt maturities, capital needs for its China capacity expansion, and depth of demand for Model 3. We expect Tesla to hope shares trade above the March 2019 conversion price, which I think is around $360, I want to say, around that conversion price, and pursue a new fixed income instrument to address CapEx and the November 2019 converts. Tesla also highlighted that its remaining 300,000 plus Model 3 reservations, indicating it expects strong sales as it introduces Model 3 into Europe early 2019. We remain bullish and raise our price target to $418 there by calling up to $418, okay? Piper Jeffries' Alexander Potter also has a buy on the stock. He says Q3 was a milestone quarter and we remain overweight rated for Tesla, with margins, earnings, and cash flow easily beating our expectations. There's still a lot of hair on this company, and Tesla remains the most volatile stock we've ever covered. But we think the bears will struggle to poke holes in today's results. Now that Tesla has achieved high volume production of Model 3 sedans, the company has begun demonstrating that, contrary to many skeptics' long-held beliefs, additional capital raises are probably not necessary. Thanks to operating leverage, OPEX control, and tight working capital management, Tesla appears to be increasing likelihood to achieve financial self-sufficiency. Our price target is moving from $389 to $396, so not a big change there, but near a $400 price target. We reiterate our overweight ratings, all right? And another sell rating here out of Needham, okay? They say Tesla posted its first quarterly profit and positive free cash flow in over 2 years, fueled by higher margin Model 3 sales. We remain concerned that the overall margin margins will decline in the first half of 2019 due to an unfavorable mix shift in Model 3s, declining ZEV sales, service margins to stay above the negative 35 to negative 40% rate, and pricing pressures on Model S and Model X. Moreover, we remain cautious on how fast and most importantly, profitably, it can produce a $45,000, not to mention $35,000 version in order to match the backlog of orders. Given the lead time data, we contend that the majority of the 455,000 net reservation list are for individuals who reserved for that base model, they say, okay? A lot of the bearish case out there is still around, can they keep up this profitability? Can they expand it? Maybe Tesla has already reached all its best customers and now it's all that's got left is $45,000 and $35,000 customers. A lot of the bearish case is around that, and maybe they'll have to raise capital again. A lot of the bearish case you're finding is just kind of these points reiterated again and again, okay? On the buy side here, they say Tesla reported a profitable Q3 even ahead of our estimates, in contrast to the consensus that kept looking for losses, as Model 3 ramp now positively flips the economic from a big cash burn to big volume leverage off the big vertically integrated fixed cost structure of the company that it has been building. We continue to forecast EPS ramping to $11+ in 2019 and $18+ in 2020, well above consensus of $2 and $9. Reiterate buy and a $430 price target there on that one, okay? So you got still a very, very big bull versus bear debate. The bear debate obviously has been shrunken down now that they posted this quarter, but a lot of bears and analysts have sell ratings are still skeptical on what type of profitability can Tesla do in the future. Is this as good as it's going to get? Personally, I've always expected Q4 to be a more profitable quarter than Q3 has been, okay? Now these Q3 numbers kind of blew me away, so I got to kind of relook into that now and see if they can still beat that. But I've always imagined Q4 would actually be more profitable than Q3. It's just these numbers have shocked me so bad. So you're finding a lot of the same bull versus bear debate as we had prior. Just the bear one is stricken down a lot because every single bear out there is acknowledging that, man, these numbers were much better than we expected. We didn't expect numbers this strong. So pretty exciting stuff out there. If you're a bull, if you're a bear, I would be a little scared at this point in time, because if Tesla can remain profitable now here on out, like that takes away a huge bearish case out there, because a huge bearish case was, oh, they can't be profitable. They're not going to be profitable, okay? If all of a sudden Tesla starts doing quarter after quarter of profitability on a GAAP basis, all of a sudden as a bear, now you're left with, oh, maybe is a valuation concern, but then when you got a stock that's revenues are going up, 82% quarter over quarter, 100 and something percent year over year, all of a sudden it's like, okay, well, valuation concerns, they're growing like crazy. I don't know if I can make that case. And if they're profitable, then what type of cases do you have left to make at that point in time? It gets to be a very, very hard position to take if you're bearish on this company. So anyways, that's my opinion on everything there, guys. Let me know what your opinion is down there in that comment section. I would love to hear from you guys as always. Thank you for watching. Have a great day.